Hello and welcome to the Intentional Brief, your weekly video update on the one big thing in cybersecurity news for middle market companies, their investors, and executive teams. I'm your host, Shay Colson, managing partner at Intentional Cybersecurity, and you can find us online at intentionalcyber.com. Today is Monday, April 7th, 2025, and I'm just here to tell you that you're not alone. We are all trying not to refresh the news or stock quotes obsessively. So for the next few minutes, let's just focus on cybersecurity. And we're going to talk this week about Oracle's doubleheader breach week. So while there might not be very many Oracle customers in this middle market segment targeted at this show, I do think it's worth talking through what's been happening over there for the past couple of weeks that are just finally hitting some confirmed news reporting. So since March 21st, Bleeping Computer and others have been reporting on a threat actor named Rose87168 claiming to have breached some Oracle services inside star.oraclecloud.com. According to Bleeping Computer, Oracle's denial of this breach was categorical. Quote, "There has been no breach of Oracle Cloud. The published credentials are not for the Oracle Cloud. No Oracle Cloud customers experienced a breach or lost any data," unquote. They are now, of course, reporting that Oracle has, quote, "finally acknowledged to some customers that attackers have stolen old client credentials after breaching a legacy environment last used in 2017, unquote, which has been confirmed with secondary reporting from Bloomberg. So while Oracle was busy denying this initial breach, they suffered a second breach in their Oracle Health offering, created after they acquired the electronic health record provider Cerner and merged them into Oracle Health and into one single cloud offering. Here, quote, "Oracle says that the threat actor used compromised customer credentials to breach the servers sometime after January 22nd, 2025, and copied data to a remote server. This stolen data may have included patient information from electronic health records," unquote. Meanwhile, the reporting goes on. Quote, "Multiple sources told Bleeping Computer that it was confirmed that patient data was stolen during the attack," end quote, and, quote, "Oracle Health is also telling hospitals that they will not notify patients directly and that it is the hospital's responsibility to determine if the stolen data violates HIPAA laws and whether they are required to send notifications," unquote. So Oracle seems to be getting a lot of practice this week in what appears to be shirking responsibility or passing the buck for their incidents, and I want to reflect on what lessons those should impart to us here in the middle market. To start, I think it should help refocus and reinforce our efforts on critical third-party providers that we use. If you're on Cerner for your electronic health record or Oracle Health, obviously that's a critical provider. We can't prevent our vendors or providers from having breaches, of course, but we can build in mechanisms to better deal with them. And this includes things like having contingency plans, but also having an accurate inventory of the data that we're sharing with these providers in case we need to do notifications ourselves or in case we do lose data from that provider, we know what was there. Furthermore, I think it's entirely reasonable to read the regulatory tea leaves here. Oracle has yet to file an 8K as required by the SEC regulation disclosing the breach, and they seem to be pushing HIPAA notifications down to impacted hospitals, perhaps because they're seeing the cuts taking place at the Health and Human Services Office of Civil Rights, which is the office that enforces HIPAA regulations. That office has reported to be cut by up to 25%, indicating a lower ability to enforce the requirements. The other lesson, I think, from Oracle's no good, very bad week revolves around our own authentication and authorization practices. Bloomberg is reporting that, quote, "Oracle staff informed some clients this week that the attacker gained access to usernames, passkeys, and encrypted passwords, which means that we've got an opportunity to rotate those credentials so that any compromised disclosed passwords, passkeys, encrypted passwords, password hashes, or anything else are no longer a risk to us on our side." Again, we need to retrench our focus on the basics, which includes third-party risk management, TPRM, and identity and access management, IAM. And while we can't solve the world's problems, we can certainly reduce the impact they have on us, and that is going to be, I think, the theme for 2025. Being resilient is only going to get harder, so the sooner we start building resilience, the better. From a fundraising perspective, we saw more than $12.5 billion in newly committed capital in the last week, but we also saw another couple of interesting notes. First, we talked last week about how the private markets might not be such a bad place to be, and our friends at Klarna, the buy now pay later startup, have decided the same, having chosen to delay their initial public offering, which was supposed to start their roadshow today. That said, we also saw a piece in the Financial Times entitled, quote, "Big investors look to sell out of private equity after market rout," unquote, reporting that large institutional investors are studying options to shed stakes in illiquid private equity funds after the rout in global financial markets pummeled their portfolios, unquote. Classic FT framing here. They write that, quote, pensions and endowments are seeking ways to exit their investments, probably at discounts to their stated value, and that, quote, the race to find liquidity signals that investors in private equity funds increasingly expect to receive few cash profits from their holdings this year and may face liquidity pressures that cause them to further retrench from making new investments. So while we do track the newly committed capital every week, we also see some continuation funds, and now we're seeing some pressure on the liquidity side or the exit side really start to ratchet up, something that's been bubbling beneath the surface for the past few quarters, and now I think we are seeing it come to the fore. 2025 is going to be a volatile year for all of us, regardless of our size, our investment portfolio, or anything else. Everyone is looking for ways to reduce their exposure to that volatility, so I suggest that you and I both plan accordingly. A reminder that you can find links to all the articles we covered in the comment section below. You can find back issues of these videos and written transcripts at intentionalcyber.com, and we will see you next week for another edition of the Intentional Brief.